Gary, he had so many. This is a Fed chair that knows how to be hawkish.
Yes.
He's scared the markets before. He's talked about inflicting pain. He's talked about financial conditions. He had a number of chances to do that. And when he did not push back against looser financial conditions, that was a very dovish sign.
Absolutely. I mean, Sarah, he had many opportunities. I mean, at one point he said, I'm neither optimistic nor pessimistic when he talked about next month's dot plots, because a lot of people asked him about pause.
How should we interpret here?
Pause?
Yeah.
And he said, look, we did plots last meeting. We'll do plots next meeting. He initially said they could be higher. Then he injected, and they could also be lower.
Right.
So he left the door open, as was said, for any potential outcome here. And as I said, he recognized the effects that we're having. And he did say, and he did acknowledge the short-term data on inflation, even if you look at PCE, the month over month or the last 3 months, and he did acknowledge this, the last 3 months, we're showing very little inflation in the system. The year over year number he quoted, but the 3 month or the month over month numbers are very low.
You mentioned the JOLTS, which came out, showed more job openings, which the Fed had previously put a lot of emphasis on. I do think he also sort of poured some water on that, too, and he said, well, wages are coming down.
He did.
We've seen that in the average hourly earnings. We've seen that in the employment cost index. And so, but again, another chance for him to be hawkish that he did not take.
Yeah, but he also interjected, look, I've got 2 more unemployment reports before my next meeting. We've got one this Friday and one the beginning of next month before they have the March meeting. So remember, we have a March meeting and then we have a month off. So, you know, I still believe what I said last time. I still believe another 25 at next meeting. They've got a month off, and then we'll see what happens from there. They could be done.
So you think 25 in March?
Yes.
And then pause.
I think 25 in March.
That's where the market is. The market expects peak funds at what, 5% or so? Yeah, that's one more 25 basis point hike.
We would be 4 3/4, 5. And they could basically say they've gotten the market to 5% at that point.
So that only works if inflation keeps coming down.
Yes.
And that's still a question, isn't it? I mean, he said it was very gratifying to see the disinflation now take effect. But he was asked by a number of reporters, including our Steve Leisman, about the impact on labor and how much that's going to drive inflation. It's hard to tell.
It is hard to tell. It is hard to tell. Look, we do have a tight labor market. But as you and I both know, and we've talked about this before, the Fed cannot create workers.
Right.
The reality of it is, if you look at prime working age adults, the participation rate is back to pre-pandemic levels. We're missing people in the older population that have left the workforce and are not coming back to the workforce. People have early retired. We've talked about that. We've also talked about, unfortunately, COVID took people out of the workforce, unfortunately. So we really just can't create these workers, and they're not coming back, and companies are afraid, in many respects, to get rid of workers. Also, look at what's going on here, and the chair did mention this. You know, we've got the President of the United States on a tour right now talking about the infrastructure bill that was passed, giving out money right now to implement that plan. We're building a tunnel here in New York, between New York and New Jersey, the Gateway Tunnel. He was in Baltimore yesterday talking about the Baltimore Tunnel. He was in Kentucky a week ago talking about the rebuilding of the bridge. That plan, that infrastructure plan, has 1.5 million jobs in it. So there is going to be more demand for jobs. So, yes, the technology industry is shedding some jobs. They were the huge creator of jobs in the last 2 years.
It's expanded beyond tech at this point.
Yeah, but it's spreading. But we're also creating new jobs. So the whole infrastructure rebuild, we're starting to create jobs. And you can see, as the chair said, there is a lot going on underneath the surface as well.
That has nothing to do with higher interest rates.